I'm Nate Lind, and I help people interested in buying or selling online businesses get the transaction done without the deal falling apart. If you're looking to buy or sell online businesses, then be sure to keep tuning in for more videos like this one. Be sure to subscribe and hit the bell for notifications about new videos and interviews. And introduce yourself in the comments. Are you a buyer or a seller? Enjoy the interview.
Marvin, today we're going to talk about how to approach buying and selling for the highest success rate. Knowing that there's a variety of ways that the mergers and acquisitions process can crash, we want to talk about how to approach, get into and work through the process to achieve a success rate at the end. So what I'd love to learn from you is, can you tell me a time when you saw someone's mindset turn into a successful mergers and acquisition situation, or how you've seen someone's mind shift change from being pessimistic and this isn't going to work into turning optimistic, and tell me a little bit about that story and what you did around that, how you helped coach them through that process.
Okay, and I think, it's just a few that come to mind, Nate, when you ask that kind of a question, and I think it's probably process focused as much as anything. By that I mean is that I think the first thing that has to happen in any situation like this is for a buyer in particular to come into the process, and a seller on the other side of the process, with an understanding that you should have to assume that everything is going to come out in the process, the good, the bad, and the ugly. So I think you have to start there. And I think if you don't start there, you have an unrealistic expectation going in. So I think you start with the idea that, hey, there's going to be some good things that are going to come out of this. There's going to be some not so good things come out of this, maybe some surprises. But ultimately, that's a normal part of the process. And I would say to you that in almost every deal that I go through, whether it's buy side or sell side, it's a similar thing that occurs there. There's a light bulb that goes on, whether it ends up being, very successful outcome beyond what anybody expected, or whether or not it hits some bumps along the way. It's usually around one of those kinds of things where it's saying, you know what, we're gonna encounter an obstacle perhaps, but we're going to understand that that's going to come, and that when we encounter the unexpected, so to speak, we're going to go through it. We're going to have a process for going through it. Is it something that is a deal killer, or is it something that simply is we've got to figure out a way to work around it? So I think creating a set of realistic expectations in the process is probably the fastest way for the process to move through successfully. Because too often, and I think brokers make this mistake frequently, is that we're all trying to avoid the negative in the process. And most buyers and most sellers understand that, hey, there are negatives here. And if I don't encounter any, that there's sometimes a lack of trust in the process. So I think you have to build a process that says we're going to look at all of these things. We're going to expect things to come up, and then we're going to have a methodology to work through them from that point of view. And I think when that happens, when the fear, so to speak, is eliminated because we see a problem, we overcome it, then I think buyers can get very excited because, you know what, I can do this. I can see where that, what the answer to this particular problem is, and I can see the other side, and I can see the opportunity. And if you don't do that and it comes up and nobody has a methodology to work through it, then it starts creating a level of resistance, and it becomes an unrealistic expectation that, gee, this should be a perfect scenario, which they never are. So I would say that as opposed to a specific situation, I would say that's normal. That's a normal process, what it should look like. It should look like problems will arise. We're going to deal with them as they come up, and we're going to get to the other side of them. So I think both people in the process, the buyers and the sellers and the advisors, have to start with the process that we're going to understand these things, we're going to work through them, and nobody's going to get overly defensive, and nobody's going to get, overly antagonistic in the process. That's not what it's for.
Where in the process do you see the most breakdown happen?
It's frequently in the accounting. There is different, one of the things I talk about entrepreneurial accounting is that we have different standards. There isn't a common standard. We're in the public world of public finance, you have audited standards, and even then there can be arguments. But in the private world, you have a whole host of different standards that are brought to the table. So the buyer may be one set of expectations about what the accounting is telling them. The seller may have another, and advisors, may have three or four. So you may have three or four different perceptions of what the accounting is actually saying, And so until you can get some commonality, that there's some transparency in saying, okay, this is what the standards are, this is where they come from, this is what this information is telling us, and we're all on that same page, at that point then the process can move forward. So you have to have a comfort level, a trust in the information that you're getting, and that's frequently where it breaks down. And one person looks at, for an example, something that's normally called an add back, which is not an accounting term at all, but we're saying, well, gee, that's not, that shouldn't be added in, for example. Well, money was spent, and why shouldn't it be added in? We get into these sort of sideways discussions about accounting, as opposed to setting up the process again so that we're clear on what the accounting is telling us and what it's not telling us. Because if we can't overcome that, we will go through the process with a lack of trust.
Can you share with us a success story or a case story about how you've guided one of your clients through this, and just kind of paint the picture of what was going on as the entrepreneur on the seller was was listing their company, if they're, and obviously for confidentiality purposes you don't need to share anyone's names, but would love to see like an actual scenario here unfold.
Sure. So I can think of one without getting into the specific of the client's particular in this situation where the buyer was being advised, by a very smart, sharp accountant from that point of view. And in this particular case, the accounting and the information that was presented to them was challenged early in the process by the accountant. It didn't accept what the accounting was telling them, didn't accept what the tax returns were saying. So they were very negative. The buyer wanted to buy the business. He relied and trusted his accountant, and he wasn't getting any reinforcement from his accountant that this information was something that he could trust. So the process broke down very quickly, because immediately it became a seller becoming defensive, his accountant becoming defensive, and you had these two advisors, sort of protecting their turf, so to speak, in that process. So in this situation, what we do is we come in and we sort of create an independent view of this. And we don't have an agenda here other than saying, look, let's get to a place we can both agree upon, and both of the accountants, so to speak, can be okay with what the outcome is saying and can agree to it. And that's about the process, right? Because you don't have an audited process to measure against. And so in that scenario, you have to create a process. And so the one in particular case, which is recent from that point of view, what we agreed to do is to come back and sort of agree upon the process of how we were going to come to a conclusion about what the accounting is telling us, right? So we set up these standards that we both can agree upon. All right, let's look at it this way. And then in that process, we set aside about 3 or 4 accounting points, information that we both knew was there, and decide how it should be treated. Let's define what an add back really is. Let's agree on what an add back really is, for example. So in that case, we did just that. We agreed upon the definition of it. We went through a process that we both agreed upon to get to an accounting conclusion that both supported the process. And then we could say, okay, here's the issues that really are the issues here. And we worked through the compromises with them. And in this particular case, it was just that. It was a compromise. One side didn't fully agree that it should be added back, and in that case, improving the income. The other side felt like that, gee, of course they should be added back. These are things that, that we're not going to be doing ever again. So in that case, what we did is we created a compromise, but nobody had to compromise their initial standards or initial positions, so we didn't really get into, let's argue who's right or wrong. Let's figure out what kind of a process can we create. And so in this particular case, this was a very successful conclusion. The deal closed, it was sold, and we ended up with both parties basically being able to transfer the goodwill of the business, which is the part you don't want to lose. Because too often in the process, somebody wins, but the goodwill is lost. So the win is a hollow victory in that situation. So in this particular case, the deal in fact did close, and it really was where you had 2 strong accounting people, both smart, both not wrong in terms of what they were doing. They just had different agendas, and neither one of them wanted to back off because their clients trusted in what they had told them previously. So it was an impasse of accountants more than it was an impasse of buyer and sellers. In that case, we were able to come in and say, look, we have no agenda here other than get to a place where we both can agree on what the information is telling us. Once we got there, we resolved it fairly quickly.
When you're advising your clients who either on the buy side or the sell side, and they either have a bookkeeper or an accountant, on staff, or an outsourced, service provider that they're using, it seems to me like that it's a little bit ego driven, and that each of the any individual is going to kind of protect their turf a little bit, because it reflects poorly on them if something's not done in a way that looks professional or airtight, especially accounting personality types. Like, they're very, very precise. They often will get into details around. You'll go down rabbit holes that have maybe nothing to do with what the actual objective is. What would you share with potential buyers or sellers that's watching this, and how they can work with and how they can communicate with their bookkeeper or their accountant or their accounting professional services firm, letting them know that the accounting process is a little bit different in just running day-to-day business versus prepping for the big M&A event?
I think the most important thing is to not try to exclude them totally from the process, right? I think it's important to, they typically are trusted. They typically are generally well-intentioned, and sometimes, very good at what they're doing, but their objectives are different. So I think, first of all, is to avoid the easy critic, being the easy critic, to come in and say, well, this is absolutely wrong, or you're wrong about this. As soon as you start getting into anyone who's an accountant or a bookkeeper or anything like that, as soon as you start telling them they're wrong, they generally are going to get defensive, because they've worked on it. They believe what they put down is correct, or they wouldn't put it down. So I think getting away from judgment about their work is really important, and understanding, to your point, and that the objective is different. And here what we're trying to do is we're trying to create a language that we can both agree upon, understand how it's sourced, and take the advocacy of either side out of the equation. So we're really saying, how do we get to an objective place of truth that's true for both parties? And I think when you do that, and then you cannot say, hey, because you have to go to these people for source information. And so if you try to exclude them into it, they will get defensive, they won't cooperate, and you won't get the transparency that you need. So I think you have to figure out, and it's always different with each person and their personality, but I think, it's a matter of any kind of communication. I think it's a level of, you have to respect who they are and where they've been and what they're doing. You can be critical in the sense of analytically critical, but you may not necessarily have to express that at that point in time to that situation. It's just, let's get everybody moving to what the new objective is, which is to get to a place where both sides are clear on what the sourcing is. And sometimes, they may view that as, okay, well, I could have told you that to begin with, and that may be true, but it's not what the process requires. And so I think you have to try to create them to be part of the solution, and not try to exclude them from the process.
Yeah, that's a huge piece I've seen over and over. I've hired internal bookkeepers. At one point in time, I had a CFO, a controller, and 3 junior bookkeepers managing an agency with 80 some odd clients. It's amazing the personality differences between a visionary entrepreneur and an analytical accounting finance type focused person. Tell me a little bit about how that personality difference has come into play in some of your client representations and some of the M&A process that you've been a part of.
Well, one in particular I can think of, which was really a very sharp bookkeeper lady, doing it. And there's a certain amount of camaraderie, I want to say, you call that, amongst accountants or people in that world. And I think most people don't realize that they oftentimes are sort of precluded from being able to do their work. By that, I mean, oftentimes the entrepreneur is such a strong personality, they got a predetermination about what they want the accounting to say, right? They aren't really listening to them as scorekeepers. And so frequently they're beaten down in that regard of the process. And they don't feel like they can be totally transparent. They feel like that they're betraying a client by being transparent or something of that nature. But I think they all understand that if they understand what the process is going to do, they understand, wow, if somebody does that process that way, they're going to find out something that my boss may not want them to understand. But as long as in that situation, the process owns that responsibility and you take it away from them, sometimes they're relieved by that. It's because they know what the answer is. they don't want to own, they don't want to out it, so to speak, in that regard, but they're supportive of it. And I think that's why it's important to get everybody to agree that an objective, getting to the truth of a situation, and that the truth, whatever it is, typically is not going to be the end of the world. I think then we can get cooperation. So to your question about specifics, one in particular, this lady was very defensive because she knew what the inadequacies were in the accounting that she was presenting and being the owner of at that point in time. But her hands were tied, and that's not too unusual. Frequently, people don't want to either develop, put the resources against, to get the kind of accounting information they need. That's fairly normal. If you beat people up over it, if you come in and say, well, that was a stupid way to do it, it doesn't accomplish anything, right? So in that regard, I think you have to respect the fact that most people really want to try to do a good job. Most people aren't trying to be deceitful. Most people are working within a limited capacity or a limited set of circumstances. And sometimes they've been given a level of responsibility and they are trying to defend that. They don't necessarily have the skill sets. They don't necessarily have the education or background to really do what needs to be done. But it doesn't mean they're not trying to do it, or it doesn't mean that they're doing anything intentionally wrong. So you have to respect where they're at. And I'm specific to the deal recently, which is a pretty good sized deal. That was exactly where the accounting team was. They were actually relieved, one, that we didn't use the process to sort of throw them under the bus, so to speak. We supported what they have done, and we all got to a better place. And, our part of that was we wanted to be able to say, hey, they're doing really a good job, which they were, given the constraints that were put on them. So we're not there to win an argument from an accounting point of view. That's a recipe for disaster almost always.
Got it. Marvin, what else is top of mind for you right now? You've seen some, changing subjects for a second, you've seen some, major shifts and changes through your entrepreneurial journey. And, we're going through some pretty significant ones here in 2020. Is there anything top of mind that you want to talk about that's important to you, something you're passionate about that you'd like to relay to potential buyers and sellers, out there in the marketplace?
Yeah, I have said, and if you go to my website, I say that on there now, and that is that I have a blog post that basically says, earnings, that earnings aren't necessarily the most important factor in valuation, right? I mean, earnings are important. Don't get me wrong; they are why we do what we do, all of us. But at the end of the day, it's about valuations. And evaluations are more complicated than what happened, for the last 3 years from an earnings point of view. That's important, and it's an important factor. But value of a company it's more complicated than that. And whether or not a company has value, I mean, you can have a beautiful hot dog stand, and you can have terrific location, and you can have all those things. But if you got a lousy hot dog, it doesn't really matter, right? And it's pretty predictable that you can put a crowd of people out there, and you may sell them a hot dog once, but if you're there next week, you're not going to sell them a hot dog a second time. So those are basic kinds of things about valuing a business that don't change. I think the other thing is that, we have lived in a period of time where, growth and success were pretty automatic. People assumed that it was an automatic, and we weren't necessarily as concerned about core things in terms of a business relationship that are important, and so value in terms of a business has some core attributes that are there in good times and then they're in bad times. Banks were faced with stress tests after the last major, breakdown in 2008. They had to go out and prove that they could handle a crisis. We're far better off as a country today because our banks are in pretty good shape because of that stress testing and that accommodation. Business is the same way. When I value a business at any time, good times or bad times, I always go through what I call a stress test for that business and says, what happens if this business loses 50% of its business? How would they survive? How would they get through it? What is likely to happen that may make that occur? Loss of a supply line, for example, heavy dependencies sometimes. So every business periodically needs to be stress test itself and saying, what happens? How do we manage through that? Because if you're a business, the intent is to be there for the long run. Stress testing the other way, scaling, right? What happens if we double this business in size? Can we do it? Are we capable of delivering a good hot dog with twice as many customers as we can with half as many customers? So those kinds of things to me are saying, every time someone buys a business, particularly, it's a long-term investment, right? You're buying it for the long haul. You're not buying it for, next year's earnings. And with an SBA loan, it's a 10-year commitment of a personal guarantee. So you have to look at those business attributes more holistically than simply the fact that it made money last year. It made money the last 2 years. That's important, but it doesn't necessarily say this is a good business.
Marvin, are there any questions or stories that we didn't talk about that you think is important that we need to discuss?
I think, one of them for me is that goodwill, and I always say this from that point of view, is that goodwill is an accounting term. We talk about it because it represents all those things that are not hard assets, but there is truly goodwill. And in terms of businesses, if you don't transfer that goodwill when you sell a business, if you don't capture that goodwill when you buy a business, if you don't capture it, then the value that you paid or the price that you paid above the asset value is lost. And so, and I say that with everyone, and I'm thinking of that more recently, where a company that just closed recently, the goodwill that was transferred as a result of the business being sold, both parties came to a conclusion without knowing what was going to happen here, right? They had no expectation of the kinds of crisis that the business would come into. But that goodwill that was transferred was very strong. And now they are almost like partners in this time frame, because the people that sold the business, is a legacy business for them, and it was important to them for these people to survive long term. And so that goodwill element's not on the balance sheet. It's not anywhere that you can see, but it's extremely valuable. And even in less trying times, that's an important lesson, because you need to capture the goodwill of a business when you pay for it.
That's awesome advice. Marvin, what are some action steps that people should start taking right now based on the advice that you gave, if they're considering selling or considering buying?
I would say, evaluate your business. If you're a seller, look at it as if you were a buyer. And if you were going to go spend the kind of money that you're going to ask for your business, is what would you expect that business to be able to do? What would give you comfort? What would give you confidence? Sometimes it's things that you take for granted about your business that you don't think are so valuable, but they are valuable. Kinds of things like, what kind of assistance are you going to provide post close to a new buyer? That's valuable. People buy a franchise with no income because of the recipes, right? How do I run it? What am I going to face? What am I going to do? How do I teach? So I would say, create your franchise so that you're buying a set of success principles, or you're selling a set of success principles, and just the reverse for a buyer in that situation, right? You need to understand that you're not buying this to reward somebody for the last 3 years of income. That's not why you're buying it. You're buying it because you expect that business to produce for you going forward. So those are the kinds of things which I say, looking more holistically at the business, can this do that? In this changed world that we are now living in, how does this fit? How does this work? So those are the things. It's just, I think, understanding how serious it is for a buyer and how serious it is for a seller, and not be simplistic in how you view the process or the value of the business.
Marvin, do you have any favorite books or podcasts or other reference material that you like to share with your clients?
Nate, that's an interesting question, because I've got probably several hundred that are contributing to that. But there's a lot of things that I think that I say in terms of books that are really important to me. One of them, and a lot of them were not what you would think. For example, there's a book on controllership, believe it or not. And I say to every entrepreneur that you don't have to be the bookkeeper. You don't have to be the accountant. You don't have to be the tax preparation expert, but you do have to understand accounting. If you cannot be a good business person by relying on somebody else to interpret the accounting information for you. I can do it. People want to pay me to do that sometimes, but it's not, as an entrepreneur, if you're going to be a good business person, when somebody gives you a financial statement, you need to understand what it's telling you. don't let somebody else explain it to you. Business owners are smart people. They frequently are not paying any attention to their accounting information because they got their own set of data, their own set of reports that they look at, and they're comfortable with that. But I would say to you that things that challenge you, like when I'm talking about a book like Controllership, or any kind of book that is their audience is not an entrepreneur, but it's to the experts around them, are that way. I would say that there's a book on advertising. I'm trying to name of it that I believe is such core. It's an old book, but it's about core advertising principles that are just as true today in e-commerce as they were in the print media before. It's core concepts about business that business owners need to understand and not simply rely on gurus to give them the answers to it. So the smarter you are as a business person, and there's a whole host of things that make you that way, I would say, hey, be in the habit of learning, be in the habit of growing, because we never get too old, and it's an ever-changing world as being slapped in the face with right now.
So controllership, like a accounting controller, and then ship, like a ship sailing away, right?
Well, yeah, Controllership, Wilson Goffer. I've got it right here on my desk as we speak, and it really is geared towards a larger company and being a controller. But it really is about someone who lives in the financial world of a business. What are you concerned about? Because too often we delegate that away, and that's okay as long as you understand what you delegated. When you get the deliverables back, what is it telling you? And so those are challenging things. Those are saying, hey, I don't want to be, an accounting primer. There's any number of them, a first year accounting, primer, from that point of view. Those are good things for business owners to read because you want to understand what experts are telling you. You want to understand the concept, because sometimes we think they do and they don't, basic concepts sometimes around that. So I would say if I see anything in the world of e-commerce today is that people are becoming successful because of the medium to such a large degree. And the business principles in stress times like this all of a sudden aren't as understood as much as they should be. So I would just encourage the concept of self-educating more and continuing to do that as a process. Like I said, I got a ton of books here and a ton of books behind me, so you can go through them, and they all have their elements. But I would say that's an important, attribute for people to get better at every element of their business.
If anyone's done a primer to help an e-commerce entrepreneur understand the, P&L and a balance sheet, please let me know, because I see so many of them that they download their reports from, if they're an Amazon seller, they download it off of Seller Central. If they're a Shopify seller, they just use their Shopify, reports or whatever their shopping cart is. And they look at all of, kind of many of them, even up to $10 million, sometimes maybe a little bit more. Usually, hopefully they've got onto some sophisticated accounting by then, but I know some that still rely on their shopping cart and CRM or whatever the reporting platform is for their financials. And that's a troubling, situation.
But it's not that normal. But I'd say to you that, it's normal in that situation. But I would say to you, hey, that's just the opportunity, because the smarter you become, the better business person you're going to become.
Awesome. Very good, Marvin. I really appreciate you coming on. Look forward to seeing you at one of our live events. I'll circle up with you after this. Any parting words before we stop? Yeah,
I would say the only parting word is that stay focused on what we're going to do, and we're going to get to the other side. If this is a skill set right now, getting to the other side is important, and managing through it is important. And it will be a valuable experience if you can look at it that way. So I would offer encouragement that there's certainly going to be better times ahead.
Marvin, thanks again for your time. Looking forward to seeing the feedback from this, and I'll be sure to keep you in the loop. Oh, quick question: do you have like any checklists or blueprints or anything that you think would be valuable for people that watch this, that we can give away? Anything that's kind of easy for you, but also informational that we can offer?
Yeah, I will get that to you, Nate. And I really have a 13-point checklist that I say, which is what we do when we do our analyticals of a business. There's 13 key attributes that every business has that I would say each business should. We use it for our own analytical. We use it for what we call our business MRI, and take a look at it and say, how do you rate on each one of these things? How do you evaluate your own business this way?
Thanks for watching. If you like this video, be sure to subscribe and tell me what you thought about it in the comments. Your comments encourage me to continue posting videos, and they give me ideas about what to post next. I read and reply to every single one. Also, if you own an online business and you're curious of how much it's worth, click the link below to get a free business valuation with a member of our team. Who knows? It may even be me you're talking to.